The following is a paid commercial announcement. The ideas and opinions addressed in this show do not reflect the views of WKBK or Saga Communications. From the Davis Oil and Propane Company studios, it's time for Financial Wellness Weekly. The opinions voiced in this broadcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Time now for Financial Wellness Weekly on WKBK.
Securities and investment advisory services offered through LPL Enterprise, a registered investment advisor, member FINRA SIPC, and an affiliate of LPL Financial. Financial professionals are licensed insurance agents of Prudential. These financial professionals are permitted to brand under Prudential. LPLE and LPL Financial are not affiliated with Chartered Financial Services or Prudential. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee the strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investing involves risks, including possible loss of principal.
Welcome to Financial Wellness Weekly on Keens News Station WKBK, Saturdays at noon. This is Chartered Financial Services. Remember, you can send us your questions and let us know what you would like to hear at cfs@prudential.com. There's also another place I will let you send information to. It's cfs-planning.com, and you can look at our website as well to get pictures of us and enjoy the sites and the information we have on there. Today, there are three of us. I am here, Nina Benton, with
Liz Newcomb
and John Benton.
And John, why don't you correct me and tell them the proper place that they should be sending the information?
I think you had it right. I think it was me that was wrong. It's cfs@prudential.com. You are correct.
Oh, let's everybody remember that. Shh. Okay. Liz, what are we talking about today?
Well, today we're going to be picking up where we left off in our discussion of timely topics and things to be thinking about as you make your way through the stages of retirement. Now we've been talking about as you're approaching retirement. But today we're going to really focus specifically on RMDs, which we'll get more into, as well as some other topics that would impact tax ramifications and income in retirement.
That's why we have John here. I see.
Exactly.
Okay. Well, first let's start with where we were when you turn your 70s. We were looking at specific ages. We were thinking about, we spoke about the 50s, what to do, the 60s, what to do, the 70s is what we're up to now. And that's huge for required minimum distribution and retirement income timing, isn't it? There are a number of bogeys that we hit, and it's a moving target for us. Recent laws have changed and have impacted that. It used to be that at 70 and a half, all of those dollars that we've been so much accumulating and focused on building for our retirement, now we have to develop a strategy for distribution. And this is when it truly hits a lot of us what the tax burden is going to be on those required minimum distributions. So it used to be age 70 and a half. But now, if you are not yet 73, if you were born up until 1959, your required minimum distribution age is 73. And if you're born after 1959, the required minimum distribution age is 75. And why is that important? What is required minimum distribution?
So essentially, the IRS wants their tax revenue.
They want their money. Show me the money. Okay.
Yeah. So we get a nice tax deduction when we add to retirement accounts, which means that money gets eliminated from our taxable income for the year. It becomes tax deferred. And so we didn't pay taxes on it when we put it into our 401k or our IRA. And so it's grown all these years. And now guess what? It's time to start
pay
taking it out and pay the bill. Yep.
Oh. And that's part of what in previous discussions we've mentioned Roth IRAs and 401ks as well, because those, while you don't get the current day deduction, do give us the capability of having that same deferred growth, but no required minimum distribution. Why? Because the distributions, the eligible distributions that come out are tax-free. And so it's not important to the government because they're not going to get any dollars in their pocket when we take them out.
Yeah. If you followed the rules around Roths, which we'll talk a little bit about today and maybe more in a later session as well.
Right.
Absolutely. So we were talking a little bit about the fact that you have to take out these required minimum distributions. So Nina, what are some things that you can do with those distributions if you don't need the money? If you're one of those fortunate people that's in a strong financial position and maybe is charitably minded.
So when we think about the required minimum distributions, it's important to know that the percentage that you take out increases every year. So there is a set rate for how much has to come out and a way to determine it based on the year-end dollar value of that IRA. It used to be when all these rules were aligned and you had to take your RMDs at 70 and a half, if you were charitably oriented and you did want to you didn't need the money from the required minimum distributions. You had the capability of doing something that was called a qualified charitable distribution, a QCD. And with that, you were able to send your required minimum distribution directly to whatever charitable organization that you wanted to, and you would not have to pay the tax on it. So that was a way to get the money out, but not have to pay the tax if you were fortunate enough not to need it. Now, as we mentioned, the required minimum distribution age has increased to 73, but now it's no longer aligned with that QCD. If you turn 70 and a half, you still are able to send money to a charitable organization, a 501c3. It has to be a qualified organization, and you will not have to pay tax on it. But there are limits to the amount, and this year you are able to give up to $111,000 per person or $222,000 for a family. And that makes a huge impact. There's a big difference. If you have a pension, or if you're still working, or if something else is going on, and you don't need that money, and you do give money to charity, that's an awesome way to be able to handle your tax bill and also give to the organizations you want to support.
I love that, Nina. Thanks so much for telling us about. So many of my clients don't know about that. It's surprising, but it's
right.
just such a great tool to have in your pocket. Maybe before we move along, we should talk a little bit more about the Uniform Lifetime Table and just let people know what rough amounts they might be expecting to have to take out. Okay. What is that table based on?
Yeah, so we have the uniform table based on how long the IRS anticipates you living, and their objective is to have you empty that account as you take your last breath. That's their goal, which is very counter to our goal for you as your financial planners, right? That's not what we look to do. So when you are 73 and you have to start taking your money out, it's 3.79% that has to come out that year. The next year, it's 3.93. The year after that, it's 4.07. So you see that very quickly it escalates. And I believe you and I had spoken about the 4% rule.
Yes.
Having a portfolio, a moderate portfolio lasting for 20 to 30 years with a 4% distribution. And we very quickly, at the age of 77 are above that 4% mandatory distribution from traditional qualified accounts.
One thing I was just going to jump in and share is that just because the IRS is making you take the money out of your retirement account and pay some taxes on it, it doesn't mean that you have to spend that money.
Shopping spree.
So again, a 4% withdrawal rate is considered sustainable, which means historically, if you've kept your withdrawals from your retirement accounts around 4% or less, you had a really good chance of not depleting your accounts by the time you pass away, not running out of money. But again, if that distribution that's required starts creeping up above 4%, then it's wise to then reinvest or save that money in another type of non-IRA account.
Absolutely. And then that also goes to something we discussed before where you'll pay the tax on it, you put it into a different account, and now that's that non-qualified labeled account where if you let the asset sit there for at least 12 months, you have to pay capital gains taxes on the growth instead of ordinary income tax. So that makes it a little more tax friendly for you when you take the funds out.
Yeah, capital gains taxes are often lower, and you have to be above a certain income limit to even be subject to capital gains taxes. And again, it's just on the growth, not on the entire balance like it is from an IRA.
Right.
So great.
Good points.
Okay, wonderful. Well, I know in another session we're going to talk a little bit more about how these required distribution rules are different for inherited IRAs, usually a shorter time frame depending on the beneficiary and all of that. But we'll get into that another day. It's just important for people to keep in mind that if you have loved ones that might be beneficiaries on your accounts, inheriting them, they are going to have to take out some RMDs potentially under different rules.
Right. And we will focus on that maybe the next time. But this time, since we have John here with us, we thought that it would be very nice to segue into, as we mentioned, the qualified charitable distributions and the tax ramifications on RMDs, and maybe people having to try to control their taxes later on in life. We have some interesting strategies and uses for life insurance. I know the two of you, was Sarah there when you went into the life insurance discussion? No. Nope. So the two of you had the life insurance discussion and dove more deeply into the various types of policies. But John, why don't you tell us a little bit about the capabilities beyond the traditional sort of things that people think about when they think about a life insurance need or desire?
Well, you set that up perfectly.
Oh, good.
There is the way people look at life insurance. Most people think about life insurance as, what do I need? What happens if I didn't come home? How my bill's going to get paid? How my family's bill's going to get paid? And that's the need. Along those lines of desire, one of the big desires that we try to tackle at Chartered Financial Services is managing taxes in distribution phase. So the things you mentioned, the IRAs, the 401ks, and other plans like Simples, SEPs, and other tax-favored saving strategies, they all have a tax bill when distribution time comes. Well, there is another use for life insurance, and it's called LIRP. I did mention this on the last show. LIRP stands for Life Insurance Retirement Plan. And in the Life Insurance Retirement Plan, you save dollars inside of a life insurance policy. Life insurance policies billed tax deferred. You can't deduct the premiums when they come in. So it's more like a Roth where you don't deduct the contributions. And while you're contributing, it's growing and growing and growing. It's growing tax deferred, hopefully growing. Investments go up, they go down. But hopefully it's growing, and you let it bake for a long time in there, maybe 10, 20, 30 years.
So there are sub-accounts inside those, so different things that people can choose based on what's offered?
Yes.
Okay.
No different than mutual funds, except they're called sub-accounts in life insurance policies.
And these are permanent policies, right, John?
These are permanent policies that you always have, both policies that don't expire like a term policy would.
If you pay them properly.
Yes. And when you are going to be taking money out of a life insurance policy at any point, whether it's pre-retirement or during retirement, you want to have planned for that. Because if you don't plan properly for that, then you could cause harm to the policy. A policy can lapse. Lapse means cancel. It could end before you end, and you don't want that.
Not ideal.
And there are rules to follow with this LIRP strategy. There are a lot of rules to follow, but the main rule is fund it properly, let it grow to a point at which it can handle the distributions, and then you take tax-free distributions in retirement.
Which is huge.
Clearly, people need to contact their tax advisors when they're doing these strategies.
With their financial advisor who does it. They definitely need someone who understands this and is familiar with it. And a lot of times when you think about this, Liz and I have said this a number of times in other sessions, we always need to start with the end in mind. What is it that you want that policy to do for you? And then you can set it up properly with your financial advisor.
Mm-hmm. And this is the type of strategy that I think is really great for someone who has a long runway and has enough money to really add significant amounts to the policy to really make it the most beneficial. Is that right, John?
It is. Now, there are two different ways we can think of LIRPs. We can think of LIRPs, again, life insurance retirement plan. We can think of it as something you do for smaller amounts. I call that a baby LIRP.
That's such a cute name.
A baby LIRP is, it's not just for the wealthy is really what I'm trying to get across here. It's, you make contributions to it.
Like a savings plan.
It has to be meaningful and significant contribution. Right. It has to be something that can grow. For example, if you save $25 a month in something, you're not going to live a 30-year retirement on the savings that's going to build. So it has to be a meaningful and significant contribution. But you plan for it. You let it grow and you pull out money in retirement at whatever amount it can handle. Now, when we run illustrations on this, we try to be very conservative with our projections on investment rate of return. But typically, we've seen that these investments have outperformed because we're very conservative. So when we design a policy to have withdrawals, we design it not to lapse. Because if you've taken your money out of your policy and then it lapses, in 1 year, you'll get a tax bill for all the money you've ever taken out at ordinary income tax rates.
Not good.
So you want to do this with your eyes open. You want to do it with a qualified professional who knows what they're talking about. And the same topic works, the same concept works for baby LIRPs or large LIRPs. We've done LIRPs anywhere from $10,000 a year of contribution all the way up to the largest LIRP we've ever put in place is $952,000 of annual contribution into this plan.
And it doesn't have to be annual for life, does it?
No. Typically, we design it. You fund it during your working years. Mm-hmm. You let it bake is what I call it. You let it just continue to grow without touching it. Just leave it be, grow for 5-10 years more, and then you start taking out. A lot of times when you're doing your financial plans, Nina and Liz, we talk about when they get up to the time when they would be taking their retirement income from maybe their qualified plans. Don't take, most people don't want their retirement income out of their qualified plans. They don't want to pay the tax. So only take out what you need to, not the full amount to run your life. Use a LIRP to do that.
John, can I ask, when it comes to these types of strategies with life insurance, is there still a desire for the death benefit? Is that still a piece, or is that less relevant here?
While I'll say it's less relevant, the death benefit is always important. It's always meaningful. It's always something that you want to pay attention to. I will also say, though, that when we design a LIRP, we design it with, we take the dollars you're going to contribute and we force the death benefit as low as possible so that the expenses in the policy are less. But there's always a need or a desire for life insurance. And the life insurance component is still important, just less important. When you are taking your distributions, the life insurance amount goes down because you're taking dollars out of the policy.
Oh, clarify that for me. So say I had a policy with a $200,000 death benefit and it has $150,000 of cash value in it. And then I start taking income from that. What happens to my death benefit?
Well, Liz, it depends on how your policy was designed. In general, whenever you would take money out of a life insurance policy, the death benefit will go down, typically dollar for dollar. So if you've had this fictional $200,000 policy and it was designed to have the death benefit increase with your investment, and you had that $150,000 of investment, your death benefit might be $350,000. Well, if you take out $20,000, you've already taken that money, so it's not going to go to your beneficiaries. So the death benefit goes down by the $20,000.
Okay, so it's pretty straightforward. It just gets reduced by whatever amount you take out.
Yes.
Okay.
Yeah. So this strategy could be anywhere from the average household up to the wealthy. And the wealthy that we've worked with, our wealthiest clients, are looking for tax-favored distributions in retirement. They're going to be in the highest tax bracket. They don't want to pay the highest tax bracket, the highest tax on their income distributions. So we designed these LRRPs for that.
They might also be limited in terms of how much they can contribute to other types of retirement accounts.
Right.
Great point. So LRRPs have no maximums. They have no times at which you must start taking your money, and you don't even ever have to take your money. If your death
No
benefit,
RMDs.
if your death benefit has grown and you don't need this income, leave it for your heirs.
That's a really great point.
And we'll focus on what benefit that might be in a minute. But when we look at that tax-free death benefit, and as well as the tax-free capability to take income, there are a number of different. You said you don't have to be very wealthy, but typically people who have perhaps deferred compensations, and in retirement they know that they are going to have defined taxable income for a certain number of years. When that deferred compensation stops, people don't like that. And you don't think about it right now, but typically the deferred compensations, the most you can push them to pay out is over a 10-year, maybe a 15-year period at most. And then there's a definite end to that. And as people start, I know a lot of my planning clients come to me and they're a little nervous about, okay, I'm at the point now where my deferred comps are stopping. What's the strategy? And it would have been hopefully before that, way before, when they were actually deferring their income, that we would also be thinking about this life insurance capability to help set up and put the money away. So while people are while they're working and putting so much into deferred compensation, sometimes we have the conversation of, let's take this money and instead of continuing to defer that compensation, use those dollars for this type of a life insurance strategy. So we look to find the dollars in people's lives to create this benefit.
Yeah, and you mentioned deferred compensation. That is a strategy that people use through their employer, typically where they can defer compensation into the future. The plus to that is while you're working, you don't pay income tax on those dollars.
Right.
But the real negative is when you take the money out, you're not paying tax just on what you put in. You're also paying tax on all the growth. So you're paying tax on everything coming out of it.
Right.
Wow. John, can I ask, with this LRRP type of strategy, is there a limitation on the age? Did you touch on that? Can I take it out before 59 and a half without penalty?
Another great point, Liz. Good question. There is no limit on age either, unlike the traditional retirement plans that people typically will use. There's no restriction on age.
So this could be a great way to, say, retire early and have some income that you could tap into that's not going to be penalized or restricted from a tax standpoint.
While that is absolutely true, I never forget the phrase that it's not about timing the market, it's about time in the market. So you want to be in for the long haul. I typically like to have my people use their LRRPs and start to take their distributions in the 70s, really. That probably is a good time. So we can make them come into play when other income things have stopped.
I see. And what are the different ways that they can take distributions? Is it just a straight withdrawal or?
So there are two ways to take money out of a life insurance policy, and in a LRRP strategy, you use both ways. Life insurance has a very tax-favored status in that when the money grows in the policy, it grows tax-deferred. And when it's time to start taking money out, when you take withdrawals, a withdrawal is considered a negative premium payment. You're removing premium. So you're removing your own cost basis. You're removing your own dollars. So there's no income tax on that, on the withdrawal. And you withdraw to your basis. Now, this is unlike every other investment other than a Roth IRA and muni bonds. When you take money out of every other investment, you pay tax on your gains first and your cost basis comes out last. So we withdraw down to the cost basis. I know this is getting very technical.
No, I love it. This is great. I'm just thinking about my understanding of annuities and how that's opposite.
It's opposite.
Yeah.
It's truly opposite. So you withdraw down to your cost basis and then you borrow against the policy. These policies, the modern policies, I like to say they're not your grandfather's policies. They have really favorable loan interest rates. Policies that were around the beginning of my career, which was 40 years ago, were 7, 8, 9% are the loan interest rates attached to those policies. Now the policies are typically around 2%. And over time, they go down to a little over 1%. So the loan interest rates are very favorable.
Wow. So much better than a mortgage rate, a business loan rate, or most other interest rates that we're seeing on anything else right now.
Pretty much better than any interest rate you can find.
But you have to have thought of this a while ago.
You have
this
to
isn't
design
something
it
that
properly.
that you can just decide to do and then use it tomorrow for that purpose.
What happens if you do, Nina?
Oh.
What was the question?
What happens if you
say
do?
I was like, I like this strategy and I'm 60 years old and I plunk in a bunch of money and I decide to take it out next year?
That is not good for life insurance.
That wouldn't work.
Think of life insurance as expenses, or there are expenses associated with it. We'll get more into that when we come back from the break.
Okay.
Awesome. Well, you are listening to Chartered Financial Services Financial Wellness Weekly on WKBK. We'll be back shortly. Welcome back. You're listening to Chartered Financial Services on Financial Wellness Weekly on WKBK. Please feel free to send us questions or topics you'd like us to address at cfs@prudential.com, or you can find us on our website, cfs-planning.com, or give us a call, 603-857-7070. This is Liz Newcomb, and I'm here with
Nina Benton.
And John Benton.
And today we've been talking about some various retirement income strategies. We've been talking about RMDs and life insurance retirement plans. Before we get into some additional topics, I wanted to just pause because John and Nina have been really busy in the community lately doing some fun stuff that I wanted to just have you guys tell us about.
Yeah, we went to a gala, or is it a gala?
Is it a gala?
Or is it a gala?
The gala?
One or the other.
Yeah. Maybe it's regional. It depends on where you are when you say it.
Yeah.
The south, the east,
I don't
west.
know.
North.
But yeah, we attended that a week and a half ago on Saturday.
Gosh, so long ago already.
And it was neat. It was a gala.
It was the Colonials.
To support the Colonial Theater and the showroom. And it was a really
great
fun
venues
night.
up here.
Yeah.
So fabulous.
And Keith Marks, I think the whole town knows Keith Marks. He's the executive director, I believe is his title. And he is just such a welcoming guy.
And we met great people there.
Yep.
People in the chamber, people with local businesses.
Yeah. And they had a fun night. It was good entertainment of eating, and they had a signature cocktail, which I didn't care for all
Did you get up and dance, John? I can't picture that.
So I didn't.
There was dancing. There was dancing afterwards.
In the showroom.
They did go there. At that point, I think we were double fisted with seltzer and something else. I don't know, but we stood there for a little bit and watched.
And they had an auction, which was a lot of fun. I did get sucked into it and paid a little bit too much for things, but it was to support a great cause.
Right.
And you got a couple good items, right?
We did. We got flower arrangements for the months of May through September from Sarah Mustin Stockwell.
Who has such an amazing garden.
Yeah, she's really cool.
What an inspiration.
She's really cool.
Oh, my goodness. We've spent some time with her after, yeah.
Yep. And then we got a bike, a Trek County. I. And I think it was Norm's bike shop that came from. Sarah and Norm donated to this cause.
Right.
And it really, really was a lot of fun. There were some really cool prizes and gifts that people auctioned on. Really neat.
Wow. Sadly, I couldn't join you guys because
You were doing some things.
You were doing great things.
Thank you. I think so too. Just the day before, I had been at the Leadership Monadnock Summit, the one-day forum that we had with the Monadnock Chamber, and it was incredible. We had some wonderful speakers, great networking, just really inspirational to just connect with other people in the community, learn more about what they're doing. I saw a friend that I haven't seen in 30 years.
Oh, cool.
Whoa,
Yeah.
so fabulous.
Yeah, so it was a really great time as well, and just reminded me how blessed we are to have this community.
Mm-hmm.
Yeah,
great.
and by the way, in addition to the fun things we're doing around town, we we mentioned on a previous show that we just moved to the Spofford area. So our house is really pretty much complete now. Really good. We've got all of our furniture in. We're feeling good. The
Gardens, not yet?
No,
gardens, not yet.
not so much.
Not yet. That'll be soon. And then, we have the office building on 191 Washington Street, and we've been taking a lot of time.
Work in progress,
putting
yes.
a lot of love into that building and making it really
Make her
bring it
shine
back.
again.
In 3 more years, she'll be 100 years old.
Wow.
And my goal is to have her looking as good as she did 100 years ago.
Yeah.
Yeah,
That's a fun project. Yeah.
Awesome. Well, without further ado, John, kick us off.
Well, we did go through a bunch on LERP. I think we've hit the main topics. And I would say if you want to know more about LERPs, just give us a jingle. Send us an email. We're here. We know we know how to plan things properly for you. We'll do the best we can. I think if you use our tagline, which is crafting custom solutions for our clients' financial future, that's not just words. That's what we do.
Really tailored, really specific, depending on each person's scenario.
Yeah.
And we do it holistically. We do financial planning to set it all up and model it as well. And then we can put those strategies in the model to see all the different what ifs and capabilities.
A lot of partnering, too, with local CPAs and attorneys, because sometimes it takes multiple professionals.
It is a team approach for sure.
To do it right, it's a team.
Yeah.
The DIYers can get things done, but you need coordination.
Yes, too much changes too quickly. You need people who know what they're doing.
Yeah, for example, that's actually a neat little segue to something I did want to talk about, the changes. We always hear about permanent tax laws. In my career, we are on our 4th permanent estate tax exemption, and it's very high right now. So an estate tax exemption, how much of your wealth is excluded from estate tax?
When you pass.
And your wealth is everything, from grandma's desk to your investments. It's everything. It all gets added up. And right now, it's a very high threshold per person that's exempt from estate tax.
So people don't think about it because they think it won't impact them.
People always will say, well, I have much less than 15. It's $15 million per person. So it's $30 million per couple. And people always say, I have much less than that. I don't have to worry about that. But there's a tax that nobody thinks about. And it's called the income tax in respect of the decedent. It's what your heirs pay on your qualified plans. What's a qualified plan, ladies?
That's the money that grows tax deferred that you then, unfortunately, had you have gotten a deduction for it, have to pay all the tax on the growth and the contribution
like
when
an
the money
IRA,
comes out.
like a 401k, like a
403B,
403b,
simple,
like a SEP.
SEPs. Yep.
All these things. And as your money accumulates in there, you watch it and you rub your hands together thinking, oh, yeah, it's growing, it's good. But when you die, there's tax that needs to be paid on that money. Your heirs have to distribute it out of your account in 10 years. And over that time, they'll pay income tax. At what rate will they pay the income tax?
Whatever their current income tax rate is in the year that they take it out.
And when they take it out, what does it do to their income?
Typically increases it if it's of any value.
Mm-hmm.
So this tax that's paid is one that we plan for. And it's, if you think about the people you know, they mostly have 401ks,
Right,
403bs.
the traditional plans.
Just about everybody has
Deferred
these things.
compensations you can throw in there too.
So it's a tax on everybody.
Mm-hmm.
And we use life insurance to pay for that tax. There are strategies on how you set them up. There's a strategy for everything we do, by the way. But there are strategies.
So this is the estate planning strategy.
The estate
for it.
planning strategy.
Okay.
And we typically like to see the policy that's going to pay the tax owned in a trust, but your legal professional will guide you there.
Why would you want it in a trust? What does that offer?
When you contribute to a trust, if you follow the rules, I say that on everything I say because there are rules to everything. If you follow the rules and the money goes, you put money into a trust or you put a life insurance policy into a trust, the death benefit on the life insurance policy is not included in your estate again, it's got to be done properly. There are rules.
So you mean if I get a life insurance policy and I'm the owner and I'm the insured and my kids are the beneficiaries, then when I pass away, that death benefit is included in my estate?
It's included in your estate.
Wow. Yeah.
And if it's a large enough policy, or if your estate is over $15 million per person, it will be subject to estate taxes, very onerous tax rates.
Because life insurance is typically a large amount. Typically people don't get small policies, right? They usually get large policies, so that can add. And something else I thought you were going to is the bill that's in the Senate right now. Talk about permanent.
Talk about permanent. So the current tax law became permanent a year ago.
Yeah, it was supposed to sunset.
And
right?
there is a bill in the Senate right now. It was introduced in March. I can't remember the number of it, 4619 or 4169, something like that. And it is to lower the permanent tax estate tax exemption from $15 million to $3.5 million.
Wow. So if you have a house or a couple of houses, or if you have belongings, and if you've done a nice job in savings and perhaps have some life insurance that you own outright yourself, it's not difficult to get above that, is it?
It's not. It's not. So while I don't think there is a chance on that passing in this Congress, you never know what the next Congress is going to be.
So much for the permanent.
Or the next president. Or you never know. You never know what's coming down the road. Again, this is the fourth permanent tax structure I've seen.
Right. Permanent for the moment.
Exactly.
Momentarily permanent. Yeah.
So, I mean, there are a lot of things to talk about here. Again, it really is a discussion with your advisor.
Mm-hmm. About what you want it to do.
Yeah.
What's the desired end effect?
Yeah.
Okay.
Yeah.
It's amazing that life insurance is such a flexible and quite valuable tool, not only for people typically only think about it for when they pass, and people also typically only think about it when they're working to protect their income. They don't think about its uses in retirement time. Yeah. And even without the LERP strategy, the tax-free death benefit for a spouse, if somebody passes away, because either a pension may decrease or go away, or Social Security, certainly one of the Social Securities will go away, and yet you still have that water bill, you still have the property tax, you still have a lot of expenses.
You know, that's funny you say that, because I tell that to people and they don't know that one of the Social Securities goes away. They believe they're going to keep at the same level of income for the rest of their lives.
Yeah.
I feel like we're so lucky in our office here at Chartered Financial Services because we have you, John, and you are an expert on this stuff. And I can't tell you how many advisors I know of that just don't have a comfort level speaking about life insurance. They don't really understand all the ins and outs because they're busy focusing on other things. But on our team, we have different people who are experts at different things, and we can leverage each other and do joint work and support each other on case design. And we're really lucky to have your expertise with us here.
Thanks, Liz.
Yeah. So we can do it all, right? We do the investments to build the wealth. We have John for the protection of the wealth, and we have the planners to put it all together.
For the distribution of wealth.
And building. Wonderful.
Great.
Okay, so what else how are we going to segue now from the life insurance component? We had mentioned a number of times the inheriting, and John also mentioned the IRD, the taxes, income in relation to death benefits. So when people pass away, what happens?
Yeah. So there are some different rules that apply to inheriting an IRA that are different from how required distributions are treated when you are the owner of an IRA. And those rules will really depend on whether you are an eligible designated beneficiary or not.
This really changed recently, didn't it? With the Secure Act and the Secure Act 2 changing the rules on everything. So for people who inherited before 2020, this might not apply to them, other than spouses. Spouses really didn't get things changed. But tell us a little more about those eligible designated beneficiaries, which didn't exist before 2020.
Right. Well, before 2020, I'll just maybe circle back to that. You had your RMDs could be stretched out across a much longer time frame.
Your lifespan. For most, right?
Yep. And now the IRS is accelerated the time frame across which they want to receive their tax income on those distributions. So for most people, other than, I'll caveat spouses, right? Spouses have a special ability to take over their late spouse's IRA and treat it as their own, in which case it will follow their own typical life expectancy RMD rules, which is great. But for everybody else who's named as a beneficiary, they typically are going to have a 10-year time frame across which they have to deplete the funds that are in the IRAs that they've received. And whether or not they have to take distributions during the 10 years or just a lump sum at the end, it has to do with whether the person who passed away was already of RMD age.
Right. You have to take at least what they were taking out each year if they were taking their required minimum distribution. But, we have strategies that we like to use with people, and then we'll circle back to the eligible designated beneficiaries. But the strategies, if it's a traditional IRA, it's not, and it's of any meaningful size, we don't necessarily want to wait the 10 years because that could be a huge tax bill at the end of the 10 years. So typically what we do is we take a 10th out each year. And if it's a Roth, we let it sit because even though you have to take the 10-year rule of emptying it, you don't have to pay any tax on it. So,
and let's just focus on that for a second. One more quick plug for the Roth. If you leave a Roth to your beneficiaries, they don't have RMDs. They do still have 10 years that they can keep the money in a Roth tax deferred. But at the end of that 10 years, they then would have to move it out of the Roth, but no taxes are due at that time.
Exactly. So you do get that extra amount of time. And it's a really nice feature. So sometimes people will do conversions, and we'll talk more about conversions next time. But the conversions allow us to move the traditional dollars into the Roth accounts, specifically for either people later on in life who want to have tax-free dollars, or if they are hoping not to have to touch it and to leave it for their heirs.
Mm-hmm. And one thing, too, that can be unfortunate about, well, not to say unfortunate about inheriting money, because any money that you get is a blessing, but oftentimes when you inherit, you're at a high earning time in life. If your parents have lived to a healthy old age before you're receiving assets from them, you might be in a high bracket when that money comes in and when you're suddenly required to start taking distributions from those IRAs. So
Right. So it does take some planning with that as well. But go back to that, the eligible designated beneficiaries. Who are people who that 10-year rule do not apply to? You mentioned the spouse.
Yep. So the spouse, again, has that option to take it as their own. A minor child of the account owner.
Now, some people may say, yeah, right. Well, when is that going to come into play? Unfortunately, we've had sometimes when there was a child who was below the age of 21 and inherited quite a sizable amount of money. So that account can continue to grow tax deferred, and the 10 years of distribution does not start until that child is in the 21st year. So fortunately, that does allow for additional tax deferred dollars. Who else, Liz?
Mm-hmm. Yep. So anyone who's less than 10 years younger than the account owner. So a younger sibling, for example.
Interesting. Yeah.
Mm-hmm. Yep. There are always some special rules for folks who are chronically ill or have disabilities as well.
Okay. Well, that kind of makes sense.
Mm-hmm.
Right. Yep. Now, if you're a spouse, though, the rules still are the same. You could either take it as your own or you could leave it as an inherited IRA. And why might you want to do that? There are a couple of different things we should talk about for the spouse.
Right. Well, one that pops into my mind is that if the spouse is younger and, they're wanting to be able to access some supplemental income from that inherited IRA without penalty, then keeping it in an inherited IRA status exempts them from any kind of early withdrawal penalty for accessing those distributions.
Yeah, because we had spoken about age 59 and a half when we were going through the ages with retirement considerations. And if you have your own IRA and you're 59 and a half, you can take assets out without a 10% penalty. But if you're unfortunate enough that a spouse passes away and you're less than 59 and a half, and maybe they didn't have life insurance, or maybe they don't have some proper planning, or you just need assets, if you leave it as an inherited IRA, that 59 and a half goes away. And it's money that you can access, just like you and I had mentioned when we were talking about why might you want to leave a 401k if you're 55 and older when you leave rather than rolling it. That 59 and a half rule goes away. So there are certain times when you have the capability to access money that you need to be guided well.
Mm-hmm, mm-hmm, absolutely. And
you two really, really have to keep a lot in your head. You have to keep a lot in your head.
We clearly have to reference our sources often too, John. But there's another rule that applies to trusts, and we won't get into all the ins and outs of it, but just suffice it to say that IRAs left to a trust are going to be subject to different distribution rules depending on how the trust is written, and some of those can be less favorable. For example, an accelerated 5-year timeline.
Which is why you want an estate attorney who understands the pass-through rules, who understands how you won't shorten that time, unless, of course, you mean to.
Right.
And it depends who you leave it to as well. That will shorten that time frame.
Yeah, there's always reasons why that might make sense, but that's really where a good estate planning attorney comes into play.
Well, that's a good point, for sure.
Yep. Well, maybe we should just briefly touch on the ways that you can handle an inherited IRA. You could take a lump sum distribution, right, Nina?
Yes, you could. Now, if that's traditional, then you're going to have to add that whatever you take out as income in that year and pay the tax, hopefully not out of the distribution you take. Hopefully you have built up your emergency fund or have other plans to pay for that tax. But yeah, you could take a lump sum.
Mm-hmm. Or you could potentially open a stretch IRA, right?
Yep. You could roll it into the IRA we were speaking about, where you could let it sit if it's that traditional one for 10 years. There are rules depending on whether the person was taking the required minimum distribution already or not that Liz mentioned. But we like, with the traditional, if it's of meaningful size, to start taking a tenth out each year so that at the end there isn't that huge tax hit.
Yep.
Yeah, we have to see what stage people are at and what other things. Are they taking Medicare premiums and things like that?
Yeah. And then there's one kind of funny thing you could do, which might make sense sometimes, right? Which is disclaiming the IRA.
You know, interesting that you mentioned that, because this is an estate planning tactic that a lot of people don't think about, that need to be addressed way before you pass away. And we've had an incident right now, unfortunately, where someone passed away and did not have their beneficiaries lined up, because in order to disclaim, there has to be a contingent beneficiary already lined up. Because when you disclaim something, so if I inherit something and I say, I don't want that, I don't need it, I'm fortunate enough, it will go down the line of beneficiaries. So if my brother was the next beneficiary and I disclaimed it, then it would go to my brother. You have no say who it goes to. I can't say, give it to my daughter instead. It's whoever is listed on the beneficiary listing as the contingent. And you cannot have touched anything. Mm-hmm. So you can't take some and then say, you know what?
Never
don't
mind.
want this. Yeah, no, it takes planning.
Wow. Interesting. I bet a lot of people don't know about that. And I bet a lot of
sure
people
they
wouldn't
don't
consider that if they needed it. But I mean, good to know about for sure.
But this is also why we do beneficiary reviews and the importance. I would throw out a question to everyone listening with your 401ks at work. Who's the contingent on there? Right? And a lot of people don't know.
Or is the beneficiary a former spouse.
Right. When was the last time you looked at it? If the administration changed or something happened, it's very possible it's not what you think, which is why we like to do reviews and speak with people to see that everything is aligned.
Part of the whole financial planning process. When you get to the end, you start again and start all over again and review.
Well, John Benton, Nina Benton, and Liz Newcomb have been your hosts today. This has been Financial Wellness Weekly on WKBK Keene. Please tune in noon Saturdays and let us know if you have topics you'd like to hear. See you next week.
Bye-bye.